Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The S&P ASX 200 tumbled more than 5% over the last two sessions, the worst sell-off in more than a couple of years. It follows growing fears in the US, the world's largest economy, is heading for recession. Roger Montgomery is the founder and chief investment officer at Montgomery Investment Management. Roger, welcome back to Fear and Greed.
Thanks very much. Great to be with you, Sean. Spare a thought for the Japanese investors who, as we speak, are down 12.4% today.
I know. Hammered. What's going on? Why is it happening?
Well, in the Japan scenario, we were talking about this across our desk today, and Dominic Rose, who's one of the portfolio managers for the Small Companies Fund, he was pointing out that there's an unwind of what's called the Japanese carry trade. So people were borrowing money in Japan to buy NASDAQ stocks, and they're unwinding that. So you're seeing that reflected in the Nikkei.
Ouch.
Nikkei's getting a lot stronger. And so that's not the case in Australia. In Australia, we're falling in sympathy, I guess, with the United States. And that really started, I think, a few weeks ago when people were starting to question something that I'd written about in The Australian, actually, about a year ago, and that was the monetization of AI. So there was a lot of hype around AI. And of course, whenever a new technology is launched, investors think that not only is it going to change the world, but everyone's going to make a lot of money, which is rarely the case. And the issue for AI is the monetization of it. And what happened was we saw some pretty key individuals in the tech industry pointing out that, and Zuckerberg was one of them over at Facebook, you know, that it's going to take some time to monetize AI. It's going to improve the experience for many users, and there's going to be some enhancements to the functionality, but that doesn't necessarily mean that they're going to be able to charge more and that people will pay more for the services and the things that they're using. And that was the big issue, I think. So then, you know, you had a lot of hype built into stocks, but not a lot of revenue growth from AI particularly. And so we saw that whole thematic start to be questioned. That started the sort of cascading of selling. And because those tech stocks represent such a large part of the market, you know, that pushes the broader indices down, the S&P 500, the NASDAQ and so forth. And there was also, I should say, a little bit of rotation as well out of those big tech stocks and into some small caps. So if you look over 1 year, for example, the NASDAQ is up about 20%. And the S&P 600, which is the small cap index over there, is up only 6% or 7%. And the Russell 2000, which is another small cap index in the United States, is up about 8%. But if you look over the last month, then what you find is the NASDAQ is down about 9%, and the Russell 2000 and the S&P 600, they're up between 4 and 5.5%. So the small cap indices over the last month have done relatively better than the NASDAQ, which is coming off because of that sell-off in the AI names or the AI thematic names that I mentioned a moment ago.
What about the macro effects? We had some labour force figures in the US late last week. We had manufacturing figures. I mean, they weren't a disaster by any stretch, but they did suggest unemployment was picking up faster than expected. Manufacturing was slowing more than expected. But they weren't disastrous. But I mean, how did that feed into it? Because that also seemed to be impetus for the broad-based sell-off, not just the tech stocks.
Well, here's the big mistake everyone makes, Sean, and that is that there is a consistent and rational response to macroeconomic news. You know, it was only a little while ago that hopes of an interest rate cut spurred a rally in stocks.
Yeah.
Now that rate cuts are more likely, and in fact rates have been cut by the Bank of England, the European Central Bank, Canada, Sweden, the US is talking about it in September. Now that that's happened or more likely to happen, stocks are coming off. You know, it's just a mistake to think that the response by the market is consistent. The same news event a year ago will prompt a different reaction to how that news will cause markets to move today. And in any case, there is very little correlation, for example, between economic growth and stock market performance in any 12-month period. So the only reason why I think markets might be more focused on macroeconomic news at times is because there's a dearth of other information that they can react to. Typically, July, for example, is pretty quiet on the individual company front because companies are preparing to announce their full year results or their half year results or second quarter results rather in the United States, and full year results here in Australia in August. And so July tends to be a bit quieter. And so investors might be looking to macroeconomic news for direction, but most of the time there's very little correlation. There's certainly no consistent reaction or response to that economic news.
Stay with me, Roger. We'll be back in a minute. I'm speaking to Roger Montgomery from Montgomery Investment Management. Okay, so where we stand this morning, what do you think will happen over the next few days? Do you think? I'd.
Well, without a gun to my head, I'd say I don't know. But if you put a gun to my head, look, I think the narrative's changed slightly. The reality is that these US technology companies, and I don't mean the AI directly exposed technology companies, just the big information technology companies, they have some pretty unique characteristics. They're based in the United States, which has helped make them popular. The US is pretty incredible as a country. It's the largest economy in the world. It only exports about 12% of its GDP, so it's more resilient and therefore less reliant on other countries' economic performance. They've got the best demographics of any developed country in the world. Their labour force is measurably more productive than most of their peers. They've got more arable land than others. And then, of course, they've got arguably the best tertiary institutions, certainly the deepest capital markets. So there's a lot of reasons to like the US economy and to like companies in the US. There's also been a flood of very cheap money that has meant people have gone and bet on those big companies. Now, those big companies have also had the second highest margins of all sectors, second highest only to real estate investment trusts. They've also got the highest forecast earnings growth of all sectors. Communication services and information technology combined have the highest earnings growth forecast. So there's lots of reasons to own these companies. All that's changed is the narrative. The narrative has switched from, hey, pay any price for these companies to, oh, gee, people are selling them to buy something else, or there might be a recession or whatever, something perhaps unrelated to the performance of these companies, and that's triggering a reappraisal of their pricing. But if you look at the performance of some of these businesses, take Spotify, for example, in the last 2 quarters, it's raised its prices for its subscription, and yet it's taken on more net subscribers in the last quarter and the quarter before that than it ever has before. I think it took on 7 million last quarter, and it's forecast to take on 5 million this quarter. And that's even though it raised its price. Now, that's an ideal business that wins more customers as its price goes up. So, again, fundamentally, there's a lot of idiosyncratic reasons for owning these stocks, but the narrative has just changed. That tells me that, it's very likely to be temporary, and people will probably want to buy stocks again when they see prices appealing enough or cheap enough.
Is it not a bad thing, though, that people now have to go to the fundamentals? So you look at Spotify, for example, versus Meta/Facebook, whereby they're saying, well, we've still got to make money out of it. Investors don't necessarily need to dump Meta, but the idea is that the return from the AI investment might just take more time in real dollars. So what's happening now, at least people have to go back and sort of forget the hype a little bit.
Yeah, well, what they're doing at the moment is they're guessing what other people are going to guess. That's the sort of that seems to be what's happening.
Good way for the market to build itself.
And people are selling in anticipation of other people selling. It's because they don't really care about the fundamentals, but eventually prices become attractive and people become more discerning. Investors become more discerning, and they look at the fundamentals again. And they say, "Wow, this thing's got no debt, it's throwing off enormous free cash flow. Its earnings are growing at double-digit rates. It's got huge return on equity, and it's entrenching its economic moat or its competitive advantages. That's the sort of business I want to own," and they buy it again. Now, the interesting thing is there's a lot of innovative, fast-growing companies in the small cap space. They've been left behind. We've talked about this in past episodes. They've been left behind in that AI rally, that mega cap rally. And so I think there's a bit of a rotation going on, and people are starting to see merit in these cheaper, smaller companies, both domestically and also overseas.
Roger, thank you for talking to Fear and Greed.
Always a pleasure, Sean. Good to be with you again.
That was Roger Montgomery, founder and chief investment officer at Montgomery Investment Management. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.